Thursday, August 15th, 2024, Monaco 64, home of alternative economics and contrarian views. Yes, I'm aware, of course, that today is the 53rd anniversary of when the monetary, financial and economic world changed. It was when President Nixon and his advisors decided to suspend temporarily the convertibility of the United States dollar into gold at the fixed rate of $35 per troy ounce. And that was a huge event, of course. If you want to find out more, listen to my video a few days ago where I spoke about it. Go on to my Bretton Woods playlist. I've made many videos about it. But what I wanted to talk about today is an indicator that is very important and has been for over 100 years, and that is the Dow gold ratio. And why is it important? Well, because, like it or not, and you don't have to agree with me, but it will happen. Gold is the ultimate store of value, and it has been over the last 2,500 years. So when you compare the Dow to gold and you look at that ratio, it gives you a lot of clues as to where the credit cycle is. And last year in May, I did a video, and I'm going to put it up here as well now in the cards, entitled "The Dow Gold Ratio Will Tell Us When the Financial Reset Will Be Complete." And the reason why I'm covering it again today is not to tell you that the same thing I did back in May last year, but to tell you that the technical picture for the Dow Gold Ratio, which is just the price of the Dow in ounces of gold, is signaling to a major leg down in the Dow Gold Ratio, which really is a signal that the credit bubble that we've had since 1980 is on its last legs. How long it will last, this final leg, is difficult to say, but I don't think it will be more than 10 years. And it might be more than 3 or 4 years, but we're very close to it completing. And we're going to go over now the last few times we've had this credit cycle and when it bottomed. Well, the first one, you have to go back to 1893, and this chart, of course, doesn't go back to 1893. It goes back to, I think, 1897 or thereabouts. But 1893 was a big, there was a big collapse in the stock market. The U.S. Treasury almost went bust. J.P. Morgan and the London bankers had to, organize a rescue with borrowed gold for the U.S. Treasury. And I would say that was the bottom of that credit cycle. And you can see that it went up for the next, 40 years or so. And we peaked in 1929 when the Dow Gold Ratio almost approached 20. And what does that mean? Well, it means that it took almost 20 ounces of gold to buy one Dow Jones Industrial Average Index. That's when the stock market topped of 1929 at 386. Gold at the time, of course, was fixed at $20.67. And that's an important factor to remember, that gold was fixed. And that was like a religion back then, because gold, you can't change the measurement of money It's like changing the length of a foot, or changing how heavy a pound or a kilo is. And some people will argue, well, there wasn't enough gold. Well, I would argue that the problem that emerged after, well, during World War I and after World War I was that there was a massive credit bubble. People became irrational. Bankers, the consumer, the public went crazy and borrowed up to here. And that's why we had this credit bubble where the stock market had a massive run up in the 1920s, where everything else, bonds had a massive run up. There was euphoria. And unfortunately, it peaked in 1929. And as we had a sound money system at the time, what happened after 1929 was probably the most gut-wrenching, deflationary collapse in the history of the United States, and probably in the history of the modern Western world. And what happened was that even though we saw President Hoover actually interfere a little bit. Some people think it was just Roosevelt, but he created a refinance corporation. He lent a lot of government money to the banks to keep them afloat, but it didn't do any good. And by 1932, the Dow bottomed around 40, and the price of gold, of course, gold was fixed at $20.67. So that ratio bottomed just around 2. And then in 1933, prior to the inauguration, things got really bad again. The inauguration of Roosevelt was in March. And as you can see, the Dow came back down after having risen quite a bit. And by the time Roosevelt had been inaugurated, one of his first acts was to stop the payment of gold to foreign countries. So he kind of took the United States off the gold standard for a while. And what I'm trying to say here, that was a deflationary reset. Loads of companies, loads of people, loads of banks, corporations, loads of them went bust, and they never came back, of course. And that was the bottom of the credit cycle. Everything was kind of destroyed. And then gold, of course, was used by Roosevelt to reinflate the system. By January of 1934, when the U.S. had amassed a lot of gold from the confiscation, but also through shaming people who were hoarding gold, he devalued the dollar from $20.67 per troy ounce to 35 in January of 1934. And I would argue that the international price of gold in dollars was already going to that level. And if you look at the chart, though, that bottom in 32, 33 was the best time to get back into the market. Yes, it took many decades for the Dow. Well, it took about 25 years for the Dow to surpass the 1929 high. It was in 1954. But as you can see, we had another credit boom up until around the 1967, 68 or thereabouts. And this is shown here on this chart, how financial assets and stocks and bonds outperformed gold because there was confidence in the system and people piled in. And as you can see, the Dow Gold ratio got up to above 20 this time, around 28. But then it keeled over in around 1968. And from then on, we didn't have quite a deflationary collapse like we did in the 1930s. And why is that? Well, because by then the Federal Reserve had been around for a long time, and a lot was done to interfere in the system. So what we had was a stagflationary collapse, and the Dow lost nominally only about 14% from that top in the mid to late 60s by the time we got to 1980. But gold multiplied from $35 an ounce to a high of 887. Some people talk about 850, but the intraday high was 887. So in terms of the Dow, in terms of gold, the Dow dropped like 94%. And that was the bottom there in 1980 of the credit boom that we had since the Depression that had topped in the 60s. And it was the right time to get back into stocks and bonds. And by 1999, as you can see here, we got up to above 40. So every time these credit bubbles are getting bigger and bigger. And why do I think that happened? Well, because we had the Federal Reserve, a central bank that was created in 1913, started operating in 1914. So the government could borrow from the Federal Reserve. And where did the Fed get its money? Well, it just created it out of thin air. Even in the 30s, before even FDR took over, the U.S. government was borrowing like $2 billion to $4 billion from the Fed. They had to change the law, of course, because the Fed, when it was created, it was only supposed to own discounted bills, not long-term government bonds. So they keep changing the rules, of course. And I highly recommend this book here, The Great Depression, A Diary of Benjamin Roth. I'm reading it right now. It's an amazing book. You need to read it. So what's happened since 99, 2000? You might think, oh, we haven't had a correction yet in the credit bubble. The credit bubble is growing even more. And to an extent, it is in terms of fiat dollars. I just saw the other day that the world debt is gone up to $315 trillion. But the key here is to get back to gold, because gold is the ultimate measure of value. As Jim Sinclair also said once, it's the true revealer of wealth. So what's been happening since 2000 and the correction of this massive credit bubble that we've had since 1980? Well, we know what happened in 2000. 2001, the dot-com bubble burst. Stock markets corrected big time. And yes, the credit cycle started turning in terms of gold. And it accelerated in 07, 08. And by 2011, we were on our way down. Of course, as you can see here, we got down to almost 6.5, the Dow Gold ratio. But there's one small thing that happened, and it goes back to the Fed, its mandates, the rules that govern the Fed. Well, the first important one, I think, in the 30s was that they allowed the Fed to start buying government bonds. And the second one was the Humphrey-Hawkins Act of 1978, which said that the Fed had to promote stable prices and balanced growth, Full Employment and Balanced Growth Act. And this has given the Fed the excuse to intervene. And not just the Fed, but other world central banks. If you remember well, here in 2011, where we had this kind of, I would say this was like a kicking the can down the road bottom for the credit credit cycle correction. You had the ECB and Mario Draghi saying we're going to do whatever it takes to keep the euro alive. That meant more money printing. 2013, we had the Japanese and Abenomics do the same thing. So, yeah, I think this bottom in the Dow Gold ratio was due to the fact that the major central bankers of the world kicked the can a little longer. And then we rose back to 22, but we never went back to that 42, 40 level. And now, as you can see, we're turning. And since the end of last year, beginning of this year, we've broken below this trend line. And that's why I think we are on our last leg here, and it's confirmed. So how is it going to play out? Well, it could be a mixture, I would say, of what happened in the 30s and what happened in the late 60s to 1980. So a mixture of a lot of bankruptcies, defaults, but also a lot of money printing and stagflation. That's how I see it. And at what price are the two instruments here going to match? Well, it's difficult to say, but one thing I would say, though, that you need to have is gold, because gold is going to outperform. And I think we're going to get to 1-to-1 or very close. And even if we're down to like 2-to-1, it might sound a bargain, but if we drop to 1-to-1, it's a huge move. And who knows, we might even go below 1, which means, let's say, you might be able to buy a whole Dow Jones Industrial Average Index for half an ounce of gold. So whatever happens, you need to think of it in relative terms. We could see gold go up to 3,000 in the next few years, and the Dow drop to 3,000. That doesn't seem very likely, but it's possible. Or we could have gold go up to 8,000 or 10,000 and the Dow drop to 8,000 or 10,000. Or these people might inflate things even more. They might bring in a war, just like Roosevelt kind of pushed the US into a war. And we could see, gold at 40,000 and the Dow staying pretty much where it is. So a little bit like in the 70s, where the Dow, I think from the late 60s to 1980, the Dow was like sideways, but the currency, of course, lost massively. So as a friend of mine told me yesterday, and I have to thank him for sending me this chart, and I built this chart myself on TradingView. He said it's peak fiat, so anything can happen. So what am I doing to protect my savings? Well, I'm holding on to my gold and silver. Don't be fooled. Silver is going to do very well as well. It's just a little bit more volatile. It's like gold on steroids. It goes up massively, it comes down massively, while gold is pretty steady. So there you go. This is a quarterly chart, of course. So we're going to get daily moves in gold like we did yesterday. But the bigger picture, in my opinion, is pointing to this credit cycle finally unwinding. And when do I think this is going to happen? Well, I think it could happen in the next few years. And the silver lining here, of course, is that once this completes, this bust or reset, the system will be ready to inflate again. It's going to happen all over again, and it's going to take years. But while it's happening, it's going to be brutal, or maybe not as brutal as it was in the 1930s. And people, if you can find this book. And I have to thank one of you guys who sent it to me. It's you haven't seen anything yet until you read about the 1930s, especially the period from 1930 to 33. It was just not nice. Anyway, with that, I'm going to wish you all a very good day. Take care. Bye.